Hey harvesters, and welcome to the channel where we run simple and straightforward options trading to generate income. My name is Matt, and in today's video I'm going to talk about three key topics. The first one being I'm going to talk about the trades that I executed for December 1st, made $1,695. That was the raw number, premium, no appreciation gain, made that money all up front. Second thing I'm going to talk about is the project state of the union. I track a bunch of metrics to dictate the project success. I will give you guys the numbers raw. You will make that determination. But for me, I'm very optimistic that everything is going well. Lastly, I plan on talking about the trades I will execute for tomorrow, December 2nd. So let's get the ball rolling. For anybody that is a returning viewer or subscriber, you know me, I like to talk about the Robinhood portfolio from the Robinhood screen because I'm going to take this number, I'm going to take this number and then place it into my spreadsheets. So that's where I'm pulling the number from. So it's not a surprise. Currently, the number for my portfolio is $222,938.74. Right now, as we can see, today lost about 0.5% during the daytime, and then overnight lost another 0.32%. Nothing too crazy. I would consider this a neutral to red market. We'll see how the next couple of days in December play out. Let's head over to the spreadsheets and let's talk about the trades I executed. All right, guys, since it is the beginning of the week, I think it is good to highlight my harvester rules. From the last time I made a video, I added 2 more rules, but this is something I've already highlighted in most of my videos talking about margin and then buying back options. So this might be a little bit raw and not too sexy, but these are the rules I follow, and it will make more sense once I head over to the Excel spreadsheets and start talking about my trading. For red markets, we consider today a red market. I never sell covered calls below my buying point. I usually just extend expirations instead. So what does this mean? This means that if the market is red and you bought shares at a certain price and the market is now trading at a lower price, instead of selling below my cost basis, which is up here, I would rather just sell at my cost basis but extend the expirations instead of potentially running a strike price below my cost basis and then realizing a loss. I have been burned a couple of times by trying to sell below my cost basis. I was getting greedy, then the market recovered fast enough, and I have a day job. I can't sit in front of the charts to then, roll the option. So that's one of my main rules. Rule number 2, green markets. I usually sell my covered calls $1 to $3 away from the at the money, as long as the market is above my buying point. So what does this mean? If my buying point is exactly where the market is, I'm choosing a strike price somewhere between $1 and $3 away so that I can capture some appreciation, but then mostly I like to take my premium up front. I would prefer taking the money up front because the market is like an ocean. There's going to be high points and there's going to be low points. It goes up and it goes down. So the more I can just get the money up front, the more linear the growth is going to be when it comes to your trading. Rule number 3, cash secured puts. I choose a delta of 0.2 to 0.3. Usually for covered calls, I don't choose deltas. I usually do like a $1 to $3 mark because it really depends on what the premium is showing, what the strike price is, what I bought my shares in, versus when it comes to my cash secured puts, usually all of my cash is in covered calls. So when it comes to my cash secured puts, I don't actually want them to get assigned. So I choose a delta of 0.2 or 0.3. And for anyone that's not familiar, a delta of 0.2 or 0.3 is the likelihood of that option executing or getting assigned. So what does that mean? There's a 20 or 30% chance of it getting assigned. I'll get into more details when I talk about my cash secured puts. Number 4, and this probably should be like the number 1 rule, is buy good investments. I only like buying the top 10 stocks in the US or ETFs like SPY and QQQ. People have mentioned IWM, and if you have a small account, I'm fine with people running IWN, but ideally, I would rather just you take that same lump of money and invest into like an Amazon or a stock that's more predictable. The reason why I like to invest most of my money into ETFs is because it's predictable, and everyone loves predictability when it comes to trading. I personally don't care for up and coming stocks. I choose the winners of today, and if it's not a winner of today, I'm going to find the stock that is the winner, and we're going to stick to it. So in my description, I usually have 6 stocks that I deem the winners and the market leaders that I like to trade. People have different ideas. People have different account sizes, but for where I'm at, those are the ones I usually trade. I mostly do ETFs though. Number 5, don't buy back your options. You made the money, don't give it back. So what does this mean? Say you have a covered call and then the market was super hot and then it blew past your strike price. Don't buy that option back or roll it, because guess what? You've made the money when that investor paid you that premium. Now you're going to take that premium you just got and buy that option back. Of course, some of it might be related to like taxes, and you're trying to do the long-term growth. That's great. But ideally for my strategy, for my covered calls, I like to wheel and deal them. So I'm totally fine with getting shares assigned away, because I'll just run a cascade put the next day and try to get shares at a better price. And the market, guys, the market is like the ocean. There's going to be times where it's going to be up, and that point where, the market is above your strike price, that's the hotness of it. But guess what? The wave is going to pass, and then it's going to be red, and then you'll be able to buy back in at a better point. Let's see. Lastly, margin usage is allowed. As you guys, for some of the recent videos I made, I've talked about margin usage. People mentioned that during the red market, I was a little too over leveraged, and that was exactly the point. When there's a red market, that's exactly when you should be putting in more money into the market to buy shares at discount. You're not supposed to do it when the market is green. You're supposed to do it when it's red. Therefore, over the last pretty much most of November, I had about $200,000 of margin. My account was about $220,000. So it was almost a 1-for-1 to my cash value. But guess what? So not guess what, but the reason why I use margin is because I like to use a spring analogy. As the market was going lower and lower and lower, I was buying shares at better prices. So I bought, QQQ shares at the 609, 606, 605. Pretty sure I bought them at like also 585 or 595. Guess what? Eventually we hit that bottom. And then when the market recovered, it's like letting go of the spring, and the spring jumped up. And then I was able to make a ton of premium off that rebound, and then decent amount of appreciation. But that's my 6 core rules. Now let's head over to the spreadsheet and talk about the actual trades I ran. Okay, guys, kicking it off with Tesla. So heading into December 1st, I had 300 shares of Tesla and then 200 shares of QQQ. And let's talk about some of the rules. For my Teslas, I have 3 different. So the way I run my trading is for every 100 shares of a stock I buy or an ETF, I like to keep it as an individual silo of money. I don't like to lump it together and come up with a cost average. I like to keep it a different silo of money, because then it's easier for me to calculate how much premium I am generating, instead of just, everything lumping it together and then you don't know at what price you actually bought the shares. Because the way Robinhood operates is it combines all of the share prices you bought, and then every time you make premium off of those covered calls, it's also going to lower your cost basis. So therefore, you might not be making money off of some of your trading, if that makes sense. But let's talk about my Tesla shares. So for my 300 Tesla shares, I have 3 different buying points: 450, 442.5, and the 440. And let's take a look at what Tesla was at when it opened. So Tesla opened today at the 425.39, and that was way far away from my buying points. So what did I do? I chose strike prices that were at my buying points. This is exactly what I was talking about for my rule number 2. If the market is way lower than my buying points, I'm just going to choose strike prices at my buying points, and I'm going to take bad premium, and I'm just going to extend out expirations. So what I do for each one of those silos of money, for the 450, 442.5, 440, I chose those strike prices exactly: 450, 442.5, and the 440. And what did that net me? The 450 strike price netted me $283. The 442.5 the strike price netted me $448, and the 440 strike price netted me $500. Today, Tesla closed at the 430.26. So these are nowhere near getting assignment. And the way that a single stock option expires is usually at a week cadence. So I still have until Friday to know if this is going to get assigned away or expire worthless. Now heading into QQQ, talking about my silos of money again, it's going to be related to, it's actually going to be related to rule number 1. Is I had a buying point at the 626.78 and then another buying point at the 622. What did QQQ open today? It was at the 613.59. So what does that mean? QQQ at the 613.59. My strike prices are way higher than that. For me to not incur a loss, I have to run strike prices at my buying point. So what did I do? I chose the 627 strike price and then the 622. And because there was a huge difference, a huge gap from the open to my buying points, I decided to do week longs for my QQQ. For anyone that's, watches my channel, I usually like to run my ETFs of SPY or QQQ as dailies, but because the price is so far away and it's a huge gap, I decided I wanted to lock my money up front, because if I looked at the premium, I was going to generate like either $20 or $30 a day. So I'd rather just take the money up front. So for my 626.78 shares I bought in, chose the 627 strike price, locked in $103 of premium. For my 622 shares that I bought in at, I chose the strike price of the 622 and then made about $216 of premium. Currently still have a Meta buy call option. It's doing pretty good. I think it's still up like 25%. I still think there's plenty of upside. And I think this is expiring, I think June of 2026. So I'm going to give it a little bit of time to breathe, but ideally I could pull out my money and have a nice little win, but I still think there's time to grow. And that's Meta. But let's talk about cash secured puts, guys. So for my covered calls of Tesla, my 300 shares of Tesla and my 200 shares of QQQ, that's pretty much all of my cash value, but I still have some buying power available. And what I like to do with my remaining buying power is I don't actually like to buy shares. I like to run cash secured puts. And why do I like to run cash secured puts is for QQQ, let's say, for example, QQQ opened at the 613.59. I chose a strike price of the 610. It was looking relatively strong, and I chose my typical delta of 0.2 to 0.3, and I made $77 off of this, cash secured put. I used Robinhood margin, but it wasn't really margin because the shares were not assigned. So theoretically, I made $77 of premium using Robinhood margin, but since it wasn't assigned at the end of the trading day, I made $77 using other people's money. Hopefully that makes sense. And then I did the exact same thing for a cash secured put for the SPY. SPY opened today at the 678.80. I chose a strike price of the 676. It closed at the 680.27. So I made $145 using margin, but not really incurring or margin interest off of that, because technically, 676 strike price is $67,600, and then a 610 strike price, I would need $61,000. So that's about, $120,000, $120,800 of collateral that I would have needed to run that option. But because none of this got assigned, I didn't incur a margin interest, made $145. And let's dive into the benefit, because ideally, like, some people are super safe. They don't want to tap into margin because they're worried that, hey, if this were to get assigned, then they now have to incur margin interest. But for me, that's fine. I would think if these were to get assigned, they're at a competitive strike price. So I'd be able to turn them around really quickly and then run covered calls so I can offload them pretty much at the money, make a ton of premium, and then just get them off the books. Well, ideally, let's get this calculator here, guys. But ideally, those two options, the $77 and the $68, that's $145. So if you guys think, hey, Matt, $145 doesn't seem like a lot of money compared to the $1,695 you made in total, but that's just for one day. $145 does not seem like a lot, but guess what? There's 250 trading days a year. If you're able to squeeze out an extra $145 a day, that's an extra $36,000, because there's about 250 trading days a year. Guys, that's 36,250. Same concept though. You might think like, Matt, $36,250 doesn't seem like a lot of money, but guess what? Let's do this over a decade period. Let's do this for 10 years. Now that's $362,000. Guys, that's more than what's in my account. So that $1,695 we just generated could be a lot more if you're just staying consistent, hitting these base hits instead of home runs and locking in that premium up front. And guess what? Now let's do it. Say I'm 32 years old. Say I do this for, 20 more years, right? So I'd be doing I would also be incurring reset. So now let's say, because I'm 32 years old, say I do this for about 30 years. So let's multiply that by 3. Guys, in a 30-year period, making an extra $145 per trading day is $1,087,500. So this is the whole premise to this channel. Small wins equals big wins. And that's what I'm trying to achieve. Running this little bit of extra margin where it's not getting assigned isn't that scary, and it isn't big of a deal. Because why wouldn't you make extra money if someone is allowing you to borrow that kind of money? That's what all of the rich people do. That's what rich investors do. They use other people's money to get to a certain point. So we need to do the exact same thing on this channel and in this harvesting program. So yeah, guys, that would be a nice, nice number in 30 years from now. So yeah, that's pretty much what I have talking about my individual trades. Let's head over to the other side of the spreadsheet and talk about the project State of the Union. I will say I didn't account for any taxes, but I was just trying to give a high level overview of, an extra $145 a day. Cool, guys. So let's take a look at the project State of the Union. So for December 1st, like I said, we locked in $1,695. The account regressed a little bit since Friday from last week. So we're at $222,870.26. If you look at the amount of premium I've generated in the last 161 trading days, that's about 8 months of trading for, the simple folk like myself. Made $75,335.18. We are closing in on $80,000. So I'm pretty excited about that. If we look at the percentage return for only trading 8 months, that's about a 46.32% return. And the change in day, it's about a negative 0.92%. Great. Looking at my trade win percentage, a couple words come to mind is predictability and consistency. I'm winning 98.76% of my trades, 159 winning days, 2 losing days. Those 2 losing days were just investor inexperience. Just watched some rolling options. Nothing more to say there. Talking about the amount of premium that I'm averaging per day, it's about $467. If you look at the average premium I'm generating per week, that's about $2,215. And then the average monthly premium, it's about $9,206. Guys, that's only from an account that's, in the beginning of April was like $150,000 to what it is now at $222. That's quite impressive. Because 2025, I wasn't going to trade for a full calendar year, I decided to project out what a full year of return would look like. And that would be about $115,000. Took the average weekly premium, multiplied it by 52, came up with this number. And based off of my initial investment for 2025, basically bringing in some money from 2024, plus putting in a little bit more cash, which so in total, that was about $150,000 brought over and invested. And that's about a 76% return based off of that $150,000. And from this range, from April to about now, it's ranged from 49 to about 77%. Cool. Let's head over to the weekly numbers, and it's going to be oddly similar to what we just talked about because we have 1 day in December and it's the first week in December. So made $1,695. Nothing really to be said there, except that is the 13th week in a row where we hit the 4-digit club. We are being very consistent basically since September. We are being very consistent, making about $1,000 or more. So yeah, I don't really have anything much more to say there, except that the harvester rules are working. And the more I'm refining them and fine tuning them, the better they're getting. Looking at the monthly tracker, December, $1,695. Tomorrow, when I run a couple more daily options, this number is going to change, but it is what it is. I will say I'm pretty stoked that the last 3 trading months, I hit the 5-digit club for the month. So I'm super happy about that. September, we hit 15,000. October was 12,000. And then last month in a red market, guys, we made $13,000. That's freaking wild. Hopefully in December, we can get the 5-digit club again, but I'm not really going to force anything. I've already made plenty of money this year, and I'm just going to stick to my core principles and my harvesting rules. Don't need to get too wild. And yeah, talk about the yearly tracker. We've mentioned it already. $75,335.18. Great. Let's head over to Robinhood, and I'm going to talk about the trades I plan on executing for tomorrow. All right, guys. So since most of my covered calls and my actual cash is already tapped out, the only thing I can run tomorrow is cash secured puts. So let's take a look. Right now, my buying power is at 598,000. Guys, I can buy like 800 more shares of QQQ and be making a ton more money, but that's not smart. So ideally, when it comes to my margin usage, I like to do a 1-for-1 dollar amount to my cash value. And whenever I run the cash secured puts, Robinhood allows me $149,000 of event contract. So that basically means I could run two cash secured puts within that $149,000 threshold. That's for cash secured puts. If I decided to buy like hundreds of shares of QQQ or SPI or some other stock, then it would tap into my margin usage, and then I can run covered calls on it. But if for running cash secured puts, I can only be tapped at this 149,000. So there is a distinct difference when it comes to covered calls and owning the shares versus running cash secured puts. Just wanted to call that out. So I'm pretty much going to do the same thing as I did for December 1st, is run a cash secured put for the QQQ and then run a cash secured put for the SPY. So let's head over and see what some numbers might look like. So looking at the trade QQQ options for anyone that's a new investor to run cash secured puts in Robinhood, you do sell put. I like to run these as 0 days, basically 1 day long options expiring December 2nd. So everything is set up perfectly. So currently QQQ is at 616.71. And because I have most of my capital and my cash tapped out, I usually, for these cash secured puts, I will run a 0.2 to 0.3 delta. So that's from just my normal operating procedures. Yeah, that's usually like $3 away from at the money. So this 613 looks pretty good. It'd be about $106 a premium. Delta is nice, so there's a low likelihood of this option executing. So ideally for tomorrow, I probably would run this 613, but it also depends on what the market is showing tomorrow morning. If the market is showing green, then I'd be more willing to move this strike price up to where QQQ is trading at right now at this 616.80. Where is my mouse? Okay. This closer to 616.80, so that might even be like a 614 or 615. But if the market's red, I might even move my strike prices even further away from the 613. I might do like a 612, 611. So it really just depends on what the market gives you. But ideally for my cash secured puts for tomorrow, December 2nd, I'm going to keep it at that 0.2 to 0.3 delta. And what between that 0.2 and 0.3 delta, whatever premium I like better is the one I'm going to choose. But as it stands right now, if it were to stay exactly the same, I'm choosing the 613. Now let's take a look at what SPY would look like. If I can just spell correctly, that would be fantastic. Cool. So we are at SPY, Spider, S&P 500 ETF. Let's head over to Trade SPY options, making sure the expiration is for tomorrow. Perfect. SPY is trading at this 679.85. So let's take a look, about $3 away. That should be about, 0.2 to 0.3 delta. So this 676 is about $68. That's a good amount of premium, but I would like something maybe in the middle of that 0.2 to 0.3. Let's take a look at what 677 is. All right, that's more like it. About 0.26, so 26% chance of this executing, about $86. So that would be what I'm going to do for tomorrow. Tomorrow for my SPY, choosing a cash secured put strike price of the 677. And just to iterate how a cash secured put works, is an investor is going to pay you this upfront money. So they'll pay me this $86. In the event that the SPY goes down from 679 to 677, I would be obligated to buy this investor shares at that price. So the only thing I need to bring for this transaction is about $67,700 of collateral. And that's what I was talking about for the event contracts. I had about 149,000. So between my QQQ cash secured put should be about 62,000. All right, no, it's about 61,000. And then for this one, for my SPY would be about 67. That would be right within that threshold and would be golden. So I can make an extra, $100 for QQQ, $86 for SPY, $186 days. Guys, let's pull out that calculator. Let's do let's do some quick math. Let me bring this guy back up. It's somewhere. All right. It's not that important, but that pretty much wraps up the video, guys. I don't really have much more to say. Hopefully your Mondays went as good as mine. So let's stay locked in, stay harvesting. Matt out, and I'll see you in the next video.